Hi, my name is Michelle and this is my screencast. I will be discussing adjusting journal entries. Adjusting journal entries involves recording the revenues and expenses of a firm. Typical accounting practices involve two methods of recording revenues and expenses. The first method is cash basis of accounting. This involves cash being recorded when revenue are received by the business, and expenses are recorded when cash is paid. The second method is accrual basis of accounting. It involves recording revenue when it is earned and expenses when they are incurred. Under the accrual basis of accounting, adjusting journal entries are made in order to assure that the entity's revenues and expenses are properly recorded in adherence to the matching principle and revenue recognition principle. Due to the misalignment in time, cash is never affected in adjusting journal entries. There are 4 scenarios that illustrate the necessity of adjusting journal entries. The first is known as deferred revenue. This occurs when cash is received before the firm's revenue is earned. For example, Amanda is prepaid $15,800 for work which will be completed in November. Since she has not yet provided the service which she has been paid for, the $15,800 cannot be recorded as revenue, but is rather recorded as a liability for the month of October. Amanda will record on the 1st of October, debit cash, credit unearned revenue, and then once Amanda has performed the service, the journal entry for the month ending November will be adjusted, debiting unearned revenue and crediting service revenue. The next scenario illustrating adjusting entries is accrued revenue, which is when cash is received by the entity after the revenue has been earned. Suppose that a business builds a bench on the 20th of April and there is a $700 fee. The business bills its customer on the 25th of the month and receives a payment on the 5th of May. Thus, the firm will record its $700 revenue at the end of the month, debiting accounts receivables and crediting service revenue. The firm will adjust this entry at the end of the next period after the payment has been received, by debiting cash and crediting accounts receivables. A deferred expense is when cash is paid before the expense is incurred. The most common example of this is prepaid rent. For example, if Darren pays 6 months of rent in January for $24,000, the journal entry would record in January, debiting prepaid rent and crediting cash. In February, after 1 month's rent has been paid, it would debit rent expense of $4,000 and credit prepaid rent. Finally, the last scenario is accrued expense. This is when cash is paid after the expense has incurred. Consider a business which has incurred $1,400 in electricity expenses for the month of June, and they do not pay this bill until July. The journal would record debit electricity expense, credit accounts payable.